You want money, not just pay rent and survive money. You want, I don't check my bank app before buying food money, freedom money, so you think maybe investing. Then you open a video and it's like, diversification, asset allocation, ETFs, market volatility. And now you're confused, slightly intimidated, and somehow being told to buy 17 different things you don't understand. Here's the truth. Investing is not complicated. People just explain it badly. At its core, investing is one simple idea. You put money into something that grows over time. That's it. So let's break this down like normal humans. Investing equals using money to make more money, not fast, not magically, just over time, instead of your money sitting in your bank doing nothing. You put it into something that can grow. Like a business. Quick example, your running example is a coffee shop. You give money to a coffee shop. That shop sells overpriced iced lattes. It makes profit. You get a piece of that profit. That's investing. Okay, simple, moving on. A stock is just ownership. That's it. When you buy a stock, you are buying a tiny piece of a company, like owning 0.1% of a giant coffee shop chain. So if that company grows, your piece becomes more valuable. Example. The coffee shop opens more locations. More people buy drinks, more profit, so your tiny ownership, worth more now, so what? Stocks go up because businesses grow, not because of magic, not because of charts. Just business growth. Here's where people overcomplicate things. Stock prices move because of one thing. People buying and selling. If more people want the coffee shop stock, right arrow price goes up. If more people sell, right arrow price goes down. That's it. Now why people buy or sell? That's based on expectations. If people think the coffee shop will make more money, right arrow they buy. If they think it's struggling, right arrow they sell. So what? The market is basically opinions about the future. Not facts, opinions. That's why it moves so much. Cool, now here's the problem. Humans are terrible investors. Seriously, we do this. Price goes up, right arrow, OMG I'm missing out, right arrow we buy. Price crashes, I'm gonna lose everything, right arrow we sell. So we buy high, sell low, which is the opposite of what works. Back to the coffee shop. You wouldn't panic sell your share just because one bad week happened, but in the stock market, people freak out over everything. So what? Your biggest enemy in investing is not the market, it's you. Okay, now let's make this practical. You could try to pick winning companies, but that's hard. Even professionals get it wrong a lot. So instead, there's a simpler option. Index funds. An index fund is a basket of many companies. Instead of betting on one coffee shop, you invest in like 500 companies at once. So if some fail, others grow. Overall, right arrow you grow. Simple, you're not trying to be a genius. You're just riding the general growth of the economy. So what? Index funds equals simple, low-stress, beginner-friendly investing. Everyone wants to buy at the perfect time. Spoiler, you won't. Nobody consistently does. Even experts can't predict short-term movements reliably. But here's what actually works. Time in the market. The longer your money stays invested, the more it can grow. Back to the coffee shop. If it grows slowly for years, your share becomes much more valuable, but only if you stayed invested. So what? Waiting beats guessing. This is where things get interesting. Compound growth means you earn returns. Then you earn returns on those returns. It stacks. Example. Your coffee shop makes profit, you reinvest it. Now you're earning on a bigger amount. Over time, this snowballs, slow at first. Then suddenly, not slow. So what? Most of your results come later, not early. That's why people quit too soon. Yes, you can lose money, short term, absolutely. Markets go up and down all the time, sometimes hard. But historically, broad markets have grown over long periods. Not every year, but over time. So what? Investing is risky short term, less risky long term. That's why you don't invest money you need next month. Let's keep it real. You spend $5 daily on coffee shop drinks. That's normal. Now imagine instead. You invest that same money regularly, not a huge amount, just consistent. Over time, that adds up. Not because $5 is magical, but because of time plus compounding. So what? Small amounts matter when repeated. Consistency beats intensity. No hype, no tricks, just basics. Earn money. Spend less than you earn. Invest the difference. Use simple investments, like index funds. Stay consistent. Don't panic. That's it, no secret formula. Quick reality check, avoid trying to get rich fast. Following random stock tips. Panic selling during drops. Overcomplicating everything. Investing money you can't afford to lose short term. Because all of that usually ends badly. So what? Boring investing usually wins. Yeah, it's not exciting, but it works. Not because investing is hard, because they Start late. Quit early. Get emotional. Chase trends. Expect fast results. Back to the coffee shop. They buy when it's popular, sell when it's quiet, repeat, lose money, so what? Behavior matters more than strategy. This is the part nobody likes. Investing takes time, years, not weeks, not months, years, but here's the flip side. You don't need to be perfect, you just need to be consistent and not sabotage yourself, that's it. Investing, making your money grow. Stocks equals owning part of a business. Prices move based on people's expectations. Humans are emotional, bad for investing. Index funds simplify everything. Time matters more than timing. Compound growth builds slowly, then fast. Short-term risk is normal. Consistency beats big moves. Most people fail due to behavior, not knowledge. Investing isn't about being smart, it's about not being stupid repeatedly. Seriously, if you can stay consistent, avoid panic, and keep it simple, you're already ahead of most people. If this finally made investing make sense, hit like, and if you're still overthinking it, that's your first mistake, subscribe.